Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we'll explore how sale-leaseback agreements function as a financial tool within the commercial real estate market in 2026. These agreements involve a company selling a property and then leasing it back from the buyer, allowing them to free up capital while continuing to use the space. This approach can help businesses improve liquidity and balance sheets while investors acquire stable, long-term assets. As we proceed, we'll look at the market conditions that make sale-leasebacks attractive now, the financial structures involved, and how they impact both sellers and investors. The image here shows a person arranging miniature buildings, illustrating the strategic placement and management of real estate assets, which is central to this kind of transaction. This sets the stage for understanding the intricate financial engineering behind these agreements in today's market. When we think about capital in commercial real estate, it's easy to focus on the obvious sources like equity investments or traditional loans. However, there is a significant amount of value that is often overlooked, capital that is hidden right within the assets themselves. This hidden capital comes from the strategic use of sale-leaseback agreements, which allow companies to unlock the equity tied up in their properties without giving up operational control. By converting owned real estate into leased assets, businesses can free up funds to reinvest in growth, reduce debt, or improve liquidity. This approach reveals a new layer of financial flexibility that isn't immediately apparent, but can play a crucial role in navigating the evolving market conditions we're seeing in 2026. Understanding this hidden capital is key to appreciating how sale-leaseback transactions are reshaping investment strategies and driving value creation in commercial real estate today. Consider a company holding commercial properties worth hundreds of millions of pounds, yet still borrowing at high interest rates to grow. This situation captures a crucial turning point in commercial real estate for 2026. Sale-leaseback arrangements, once simple financing tools, have transformed into complex financial strategies that management teams now rely on to unlock and optimize capital. In today's market, these structures are essential for companies looking to make the most of the hidden value in their property portfolios while managing costs and funding expansion more efficiently. The image here highlights the flow of value exchange between property assets and capital, illustrating how these transactions can revitalize financial strength without losing operational control. To understand sale-leaseback agreements, it's important to see how they work as a financial tool. Essentially, a company sells its property to an investor and then leases it back, allowing the company to free up capital tied in real estate while still using the property for its operations. This arrangement can improve cash flow and reduce borrowing costs, which is especially valuable when interest rates are high. It also shifts ownership risks to the investor while the original owner retains control of the asset through the lease. Sale-leasebacks can be a strategic way to unlock hidden capital without disrupting the business. A sale-leaseback is a financial transaction where a company sells a property it owns to an investor and then immediately leases it back under a long-term agreement. This arrangement allows the company to get cash right away from the property sale while still using the property for its operations as before. From the investor's perspective, they gain a stable asset that generates rental income through a long-term lease with a reliable tenant. Essentially, this strategy turns a property that was previously tied up and hard to convert into cash into liquid capital, all without disrupting how the company runs its business. This way, the company can redeploy that capital for growth or other needs while maintaining control over the space it needs. Imagine a manufacturing company that owns a factory valued at £100 million. Instead of holding on to the property, the company sells it to an institutional real estate investor for the full £100 million. At the same time, the company signs a 20-year lease agreement to keep operating in the same facility. This means daily operations remain unchanged. The company continues to produce as usual using the same space. The significant shift happens financially. The company's turned a physical, illiquid asset into a large sum of deployable capital. This influx of cash can now be used to fuel growth, reduce debt, or invest in other opportunities, all without disrupting how the business runs. It's a strategic move that unlocks hidden value while maintaining operational continuity. Let's explore why sale leasebacks have evolved into financial engineering tools by 2026. Companies increasingly use these transactions not just to free up capital, but to optimize their balance sheets and improve financial flexibility. By converting owned real estate into liquid assets while maintaining operational control through leasing, firms can reduce debt levels, improve return on assets, and manage tax liabilities more efficiently. Investors, on the other hand, benefit from stable long-term rental income. This strategic use of sale leasebacks reflects a broader trend where businesses leverage their property assets as part of sophisticated financial planning rather than just simple asset sales. In the past, companies primarily used sale leasebacks just as a way to quickly raise cash, but by 2026, this approach has evolved significantly. Now, sale leasebacks are a strategic tool to better allocate capital and enhance shareholder value. This shift happens because there's a widening gap between the rates investors expect from commercial real estate, the costs companies face when borrowing, and the returns companies generate from their core business activities. If a business can sell property at a higher valuation and then reinvest that money into projects that deliver returns well above the lease costs, it transforms the transaction from mere refinancing into a smart financial strategy. Essentially, it becomes a way to engineer capital more effectively, making better use of the company's assets to support growth and value creation. Let's take a closer look at the capital allocation equation, which helps us understand how companies decide where to put their financial resources for the best returns. It's about balancing the cost and benefits of different uses of capital, such as buying assets, paying down debt, or returning money to shareholders. In the context of sale leasebacks, this equation guides whether selling a property and leasing it back makes sense financially, by comparing the immediate cash inflow and ongoing lease costs against the potential returns from investing that cash elsewhere. Understanding this equation is key to seeing why companies now use sale leasebacks not just to raise cash, but to strategically optimize their capital and enhance shareholder value. Imagine a company owns a distribution centre valued at £50 million, which currently earns a return of about 5%. Management sees better opportunities elsewhere that could generate returns of 15%. Instead of keeping the capital tied up in a low-yield asset, the company can sell the property and get £50 million in cash, lease the property back to keep operations running smoothly, and then reinvest the cash into these high-return projects. This process, known as sale leaseback engineering, essentially swaps out a low-yield investment for one with much higher returns, making better use of the company's capital. This approach is at the heart of how companies optimize their capital allocation today. Several key market dynamics are shaping the surge in sale leaseback transactions as we approach 2026. First, rising interest rates are making traditional debt financing more expensive, prompting companies to seek alternative ways to free up capital. Second, there is growing investor appetite for stable long-term income streams, which sale leasebacks provide through predictable lease payments. Third, businesses are increasingly focused on optimizing their balance sheets to improve financial flexibility and shareholder returns, using sale leasebacks as a strategic tool rather than just a cash-raising mechanism. Lastly, technological advances and changing operational needs are driving companies to reevaluate their real estate holdings, favoring arrangements that allow them to unlock value while maintaining operational control. Together, these forces are creating an inflection point that is reshaping the commercial real estate landscape. Interest rates are much higher now compared to the ultra-low rates we saw in the 2010s. This makes traditional borrowing more costly for companies, pushing them to look for other ways to raise capital. One effective method is to monetize existing real estate assets instead of taking on more expensive debt. Sale leasebacks offer a solution by allowing companies to unlock capital tied up in their property without increasing their debt-to-equity ratios or risking breaches of loan covenants. This approach provides a flexible alternative that supports better capital allocation while managing financial risk. The image of modern office buildings highlights the type of valuable real estate that companies can leverage through these transactions. Pension funds, insurance companies, sovereign wealth funds, and REITs are actively looking for assets that offer stable, long-term income. Sale leaseback transactions are an attractive option because they provide predictable cash flow, secure long-term leases, and involve tenants with strong credit profiles. This demand from institutional investors helps keep property values high which means companies can sell their real estate at premium prices. This ongoing interest plays a key role in making sale leasebacks a valuable tool for optimizing capital and supporting corporate strategy. Shareholders are increasingly focused on how well management uses a company's capital. They look at returns on invested capital, how much free cash flow the business generates, and how earnings are growing. When a company owns operational real estate, a large amount of capital is tied up in properties that often deliver only modest returns. This creates pressure on executives to clearly justify holding onto real estate rather than putting that capital to work in ways that might yield higher returns. Sale leasebacks offer a solution by freeing up capital that's stuck in these lower yield property assets, allowing companies to reallocate resources more efficiently and improve overall financial performance. Many companies are shifting towards asset-light business models because this approach lets them concentrate their resources on what they do best, instead of managing properties. Owning real estate is increasingly seen as a support function rather than a key strategic advantage. Sale-leaseback deals help companies make this shift by unlocking capital tied up in property ownership. This frees both financial resources and management focus, allowing businesses to operate more efficiently and invest more in activities that truly set them apart from the competition. Beyond providing immediate liquidity, sale-leaseback transactions offer several important benefits for businesses. First, they enhance financial flexibility by freeing up capital that can be reinvested into core operations, growth initiatives, or debt reduction. Second, they improve balance sheet metrics such as return on invested capital and asset turnover, which are closely watched by investors and can positively impact a company's valuation. Third, these transactions allow companies to maintain operational control of their properties through long-term leases, preserving stability and predictability in their cost structure. Finally, sale leasebacks support a more asset-light business model, enabling firms to focus resources and management attention on their primary business activities rather than real estate management, which can be complex and time-consuming. Altogether, these benefits make sale leasebacks a strategic tool that goes well beyond just unlocking cash. Many companies hold a significant portion of their value in commercial properties, which represents a large part of their overall assets. By converting these assets into cash, businesses can unlock capital that can be used in several important ways. This cash can fund acquisitions, allowing companies to grow through strategic purchases. It can also be invested in technology to improve operations and efficiency. Expanding operations becomes more feasible with ready capital, which supports scaling up production or service delivery. Additionally, converting property to cash helps reduce debt, improving the company's financial health. It can also be returned directly to shareholders, providing them with value while enhancing investor confidence. Overall, releasing trapped capital in real estate improves financial flexibility and allows companies to respond quickly and effectively to new market opportunities, keeping them agile and competitive. When a company owns a lot of property, it can tie up a significant amount of capital, which might make their return metrics look weaker compared to competitors who use asset-light models. Using a sale-leaseback strategy can help by converting those owned properties into leased assets. This improves key financial measures like return on assets and return on invested capital, and it also enhances capital efficiency ratios. Investors often respond positively to these improvements, which can increase the company's equity value. So sale-leasebacks don't just unlock cash, but also make the company's financial performance look stronger and more attractive to investors. Fast-growing companies often face the challenge of needing capital more quickly than what retained earnings can provide. Sale-leaseback transactions offer a practical solution by unlocking funds that can support various growth initiatives like entering new markets, expanding manufacturing capacity, driving digital transformation, or investing in product development. This approach allows businesses to access significant capital without taking on additional shareholders or expensive debt. As a result, sale-leasebacks become a valuable financial tool, giving ambitious companies the flexibility to grow efficiently while maintaining control and preserving their capital structure. This helps align with the ongoing goal of improving capital efficiency and corporate flexibility, which we've discussed earlier. This approach keeps the company in its existing location, allowing operations to continue as usual without interruption. Employees maintain their routines, customers receive the same level of service, and suppliers experience no change in how they engage with the business. This continuity sets it apart from other ways of raising capital that might require relocating or completely selling off assets. By preserving the operational footprint, the business can unlock valuable capital without disrupting daily performance, making this a smooth and efficient way to support growth while minimizing any potential impact on ongoing work. Executing a sale leaseback involves a clear 5-step process that helps businesses unlock capital while maintaining operational stability. First, the company identifies the property to sell and assesses its market value with the help of experts. Next, they find a buyer, typically an investor or real estate firm interested in purchasing the asset. Then they negotiate the lease terms to ensure the company can continue using the property under favorable conditions. After finalizing the sale and lease agreement, the transaction is completed and the business receives the sale proceeds. Finally, the company focuses on integrating the new lease obligations into their financial planning, ensuring smooth ongoing operations without disruption. This process balances liquidity needs with continuity, making it a practical strategy for many growing businesses. The first step is to identify the commercial properties within the company's portfolio that are best suited for monetization. This requires an independent valuation where experts assess the market value based on several factors like the property's location, the quality of the asset itself, potential lease income, and current market conditions. Once the valuation is complete, the next step is to market the property to potential buyers such as REITs, pension funds, private equity, real estate investors, and insurance companies. This marketing process is crucial since creating competition among buyers can drive up the valuation and lead to more favorable deal terms, ultimately enhancing the value that the company can unlock from its assets. At this stage, management focuses on negotiating key lease terms, including the duration, rental escalations, renewal options, maintenance responsibilities, and exit provisions. These details are essential because they significantly impact the overall value of the transaction. Once negotiations are complete, the transaction closes, transferring ownership to the investor, while the company receives the sale proceeds and immediately starts operating under a long-term lease. What sets the most successful sale-leaseback deals apart is how well management reinvests the freed-up capital. The goal is to put this capital to work in ways that generate returns higher than the ongoing lease costs, creating long-term financial benefits for the company. Let's look at some real-life examples of how companies have successfully used sale-leaseback strategies to support their growth and maintain operational continuity. These cases illustrate how businesses have unlocked capital tied up in their properties, allowing them to invest in new markets, expand manufacturing, or drive digital transformation. At the same time, these companies continue to operate from the same locations, minimizing disruption for employees, customers, and suppliers. By negotiating favorable lease terms, they ensured a smooth transition and preserved long-term flexibility. These examples highlight the practical benefits and considerations involved in executing sale-leaseback transactions effectively. Walgreens Boots Alliance has long leveraged its property assets by selling retail locations, but retaining the right to occupy them through long-term leases. This allows the company to free up capital to invest more in its core retail and healthcare services without disrupting store operations. Similarly, McDonald's, although traditionally focused on owning the real estate behind its restaurants, has also used sale and leaseback or restructuring strategies when needed to optimize how they deploy capital. This approach helps them maintain a solid presence in their locations while freeing resources to improve their business operations. Both companies show how sale leasebacks can be used effectively to balance real estate value with ongoing operational needs. MGM Resorts completed a significant sale leaseback transaction by monetizing its major casino properties, which generated billions in proceeds, while allowing the company to keep operating those venues under long-term leases. This approach helped MGM unlock substantial capital without disrupting its core business. Similarly, industrial and logistics operators across North America and Europe have been turning to sale leasebacks to finance investments in automation, warehouse upgrades, and supply chain expansion. This strategy supports operational growth while freeing up funds tied in real estate assets, enabling these companies to modernize and scale effectively. Now, let's look at the advantages of sale-leaseback agreements. These arrangements allow companies to unlock the capital tied up in their real estate by selling the property, but continuing to use it through a lease. This provides immediate liquidity without disrupting operations. Additionally, sale-leasebacks can improve balance sheets by converting fixed assets into cash, which can be used to fund growth or reduce debt. They also offer flexibility in managing real estate portfolios and can result in tax benefits depending on the structure. Overall, this strategy helps businesses optimize their financial position while maintaining control of essential properties. A sale-leaseback arrangement offers 6 key advantages that can significantly benefit a company. First, it unlocks immediate liquidity by allowing large amounts of capital to be accessed quickly without the need to issue new equity or take on additional loans. This cash can then be reinvested into projects that offer higher returns than traditional property ownership, potentially increasing shareholder value. Additionally, the company gains enhanced balance sheet flexibility as its liquidity metrics improve, opening up more financial options. Operationally, the business can continue functioning from the same location with minimal disruption, maintaining continuity. It also provides access to institutional capital that might not be available through conventional finance markets, broadening funding opportunities. Finally, it reduces the burden of managing the property since some ownership responsibilities transfer to the new landlord, allowing the company to focus more on its core operations. Before moving forward with a sale-leaseback strategy, it's important to carefully consider some potential disadvantages and risks. While this approach can unlock capital quickly, it also means giving up ownership of the property, which could limit future flexibility or control. Lease obligations may increase long-term costs, especially if rent escalations are built into the agreement. There's also the risk that the property's value could appreciate substantially over time, meaning the company might miss out on that gain. Additionally, if the business faces financial difficulties, ongoing lease payments could become a burden. It's essential to weigh these factors against the benefits and ensure the terms align with your company's long-term goals before proceeding. When a company enters into long-term lease agreements, it commits to rent payments that can last for decades, which means it no longer owns the property and can't benefit from any future appreciation in asset value. This shift from ownership to leasing can limit strategic options, making it harder to relocate or restructure operations since those lease commitments must be honored. Another important risk involves inflation and rent escalation, as many leases include annual rent increases that might outpace the company's growth, squeezing margins over time. There's also the risk that the expected growth from reinvesting the proceeds depends heavily on management's effectiveness. If those growth assumptions are too optimistic, it can lead to financial shortfalls. Lastly, relying too much on leased assets rather than owning property can create vulnerabilities, especially during economic downturns, because the company doesn't have physical assets to leverage or sell. All these points highlight the need to carefully weigh the long-term risks before adopting a sale-leaseback or leasing-heavy strategy. In 2026, sale-leaseback agreements have evolved beyond simple financing tools to become sophisticated methods of financial engineering for companies in the commercial real estate market. When used strategically, these agreements allow organizations to take advantage of differences between real estate yields and returns from their core operations, improving key financial metrics and driving faster growth. However, the real value lies not in the transaction itself, but in how a company manages and leverages the capital afterward. The most successful companies are those that see real estate not just as an asset on the balance sheet, but as a strategic tool to unlock capital and create greater shareholder value over time. This approach turns real estate into a dynamic resource that supports long-term growth and financial health. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.